The stock market has been on a roller coaster ride. Take, for instance, Nifty 50, the most common benchmark index, which represents the largest 50 companies of our country. It hit a record high of 26,277 in September 2024, but dropped around 16% to 22,125 by February 2025. Every time the market falls, panic sets in. Investors fear more losses and headlines predict doom. But here's the truth. Market crashes are not rare. They're a very normal part of how markets work. Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In this video, we are going to show you how common market falls are. We'll break down why market crashes happen, how often they occur, and most importantly, how market corrections can be your golden opportunities. We'll talk about smart ways to utilize the market falls. So markets rise, fall, and recover. It's just how they work. Historically, despite wars, financial crises, and pandemics, the Indian stock market has consistently moved higher over the long term. So let's start with understanding what market correction means. A correction is when the market drops 10% or more from its recent high. A bear market is deeper fall of 20% or more. Stock markets don't move in a straight line. They keep on moving up or going down based on the basic demand and supply. Basically buying and selling. So if there is selling pressure in the market where more investors are selling than buying, it generally leads to a fall in prices as sellers may lower their prices to attract buyers. And as a result, stock markets tend to fall and vice versa. So you must know that corrections are not rare. They are part of normal market cycles. You would be surprised to know that Sensex has spent 90% of its time below its previous all-time high. That means the market is in a correction or drawdown most of the time. So since 1980, Sensex has had over 15 corrections of 15% or more, nearly one every 2-3 years. Even in strong bull markets, 5 to 10% dips happen annually. So take a look at your screen and you'll find that 20% falls are far more common than you think. Even in years when the stock market went up, there was at least one 10% plus fall. Then as you can see, in the last 45 years, Sensex has given positive returns in 35 years. That's 75% of the time. The worst year was 2008 with a negative 51% returns, while the best year was 1985 when markets soared 94%. So understand this. On an average, markets experience a 20% drawdown every year. And in 75% of years, we have seen falls of at least 11%. What about the latest Nifty 500 correction? A 10% drop in just 2 months. But this isn't unusual. It's part of the cycle. But then why does it feel worse? Because the absence of such corrections for a long period has made this downturn feel more intense. But well, while corrections can be scary, smart investors do not panic. They see correction as opportunities to invest at lower prices, knowing that markets eventually recover. A 15% correction might feel steep, but history shows that markets have recovered from much worse crashes. Let's look at some numbers. The dot-com bubble, 2000-2001. Sensex fell 56% but recovered in 2 years and 3 months. The global financial crisis, 2008-2009, a 61% fall, but full recovery took just 1 year and 8 months. The COVID crash, 2020. Markets fell 38% in 2 months but recovered in just 8 months. Even the worst crashes in history have been temporary. Take 2008, the market lost over 60%. But those who stayed invested saw their portfolios double within a few years post-recovery. So the takeaway here is selling in panic locks in losses, while staying invested turns downturns into gains. Okay, now let's get on to the most crucial part of the video. How to handle market corrections and make smart use of such periods in the stock market to up your investing game. First things first, avoid panic selling. Studies show that retail investors lose money not because markets crash, but because they panic and sell at the worst time. So instead of trying to time the market, a better approach is systematic investing, staying consistent with your investments regardless of short-term volatility. Then, continue your SIPs. Continuing your SIPs work like magic, whether in large cap, mid cap or small cap stocks. So when markets correct, stock prices fall, meaning you buy more units at lower prices. It is the same thing like if there is a discount, you can buy more apples for the same price. So in investing, Over time, this lowers your average cost of purchase and helps you in maximizing your long-term gains. In fact, we have already made a video on 8 ways to master your SIP game. After watching this video, do watch it out. The link is in your description. Then long-term investing pays off. If you stay invested for at least 10 years, the chances of seeing losses in equities are rare. Surprised? Let's look at some numbers. So over a decade, SIP investors have earned average returns between 11 and 16% depending on the index. As you can see, SIPs in Nifty 100, which invests in the country's top 100 companies, have delivered an average return of 11.5%, with the worst case scenario at 2.8%. SIP in Nifty Midcap 150, which covers the next 150 companies ranked from 101 to 250, performed even better, with an average return of 15.9% and a worst case return of 4.6%. Meanwhile, SIPs in Nifty Small Cap 250, which represents companies ranked 251 to 500, saw an average return of 13.3%, but the worst case dipped to minus 1.8%. Now, while large and mid-cap investments remained positive, small caps occasionally delivered negative returns even over a decade. But here's what is interesting. Just one extra year of holding made a huge difference. So for instance, Nifty Small Cap 250's worst case return of minus 1.8% improved to 13.3% in just one more year. This highlights a key takeaway. Staying invested for the long term significantly increases your chances of positive returns. Market crashes may feel scary, but history shows they are temporary. As an investor, understand this. Figuring out where to invest is easy, but holding on to that investment in times like these is the most difficult part. So stay invested and don't make a mistake of skipping your SIPs. And the next time markets fall, ask yourself, will you panic or will you use it as an opportunity? Hope you liked this video. Don't forget to like, share and subscribe to our channel, and we'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.